Welcome to Tech Talk Tuesday. I'm your host, Karla, and with me today is my fellow co-host and CMT, David Blake. It's Monday, June 3rd, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend. How are you
Had a good
today?
weekend. Thanks, Colin.
All right, great to hear. Well, let's get started by taking a look at the market letter.
Okay, we had a down week last week for the major averages. It was overall a pretty volatile week. We kicked off with the NASDAQ and the technology sector hitting new highs on Tuesday after coming back from the holiday weekend. They punched new record highs, and mainly on strength in semiconductors. Once again, we had NVIDIA and AMD, Broadcom, Qualcomm, that kind of stuff all moving higher. But the Dow Jones was going the opposite direction. In fact, they carried a 3-day stretch over the first of the week, where actually the blue chip index was down 958 points. That's 2.5%. And that was over a 3-day stretch. And basically it was off about 5% from the day it cracked the 40,000 mark on the thing. It was kind of a straight downhill from there. A lot of the more industrial type stocks were coming down. The tech stuff still looks good, but we had a little bit of uptick in rates, and that was a little bit bad for the banks. We had, kind of going back and forth. We had the 2-year flirting with 5% here just earlier, to start the week out. Ended up coming down to 4.885 on Friday, and that was basically because we had the PCE, which is the Fed's preferred gauge on inflation, came in pretty much in line. It was, maybe a small tick down from the prior month, which was okay, and that helped prop up prices on Friday. And it was kind of funny because at the end of the month, or at end of the day, we ended up getting quite a impressive rally. A lot of that was just, window dressing. The money managers do this at the end of the month all the time. At the end of June, we'll probably see that again, as that's the end of the second quarter and the first half of the year. What they do is they get rid of a lot of their losers, and they got to pick up some of the big winners. So when they get their statements for their clients, it shows that they own the top performing stocks, and it makes them look good. But anyway, we had some back and forth earnings. They were kind of a hit and miss. Software giants, Salesforce, symbol as CRM, which is in the Dow, they had some disappointing numbers. They kind of cut their forward guidance. That really kind of shook up some of the different software tech stocks. I know Microsoft was off about 3.5% at one point, and software ETF was down 5.61%. So that was a little bit of a surprise to the market. But then we also had a drop in Dell Technologies. That actually sent the NASDAQ down triple digits, I think, on Friday before they came around and erased all that. And I think they ended up flat at the end of the day after that late rally.
And which sectors of the market were the laggards and which ones were the leaders?
Sectors were mixed. We had energy and REITs and utilities drifting higher. Technology was the softest last week. It was down 2.28%, and that was followed by weakness in industrials and healthcare. But at the end of that rally on Friday, we still had the Dow down for a second straight week, and the NASDAQ and S&P 500, they snapped their five-week win streak, which, we've been kind of going sideways actually for about several weeks now. So it wasn't a big surprise to see them. They weren't able to break out, to build on that Tuesday rally. And in fact, the Tuesday rally, let me check my records, but I believe it was on negative breadth, which is kind of strange. Usually, when you're expecting to see, you see an index like the NASDAQ break out to a new high, you expect to see the breadth, which is the advanced decline lines and, new highs, new lows, bullish. And we had negative breadth on those 2 days. So it was done with a very small group of stocks that pushed the NASDAQ and tech sector to new highs on that day. So that was something to kind of watch. And on the flip side of that, which I wrote about it, the thing, when we started to see on Thursday and Friday with the indexes down, underlying breadth was positive, which again was very strange. What that means is you have a little bit of profit taking in some of these overweighted stocks. And if you have something like a NVIDIA go down 2% in an afternoon, that can really affect affect the broader market and some of the bigger indexes because they have such a big weighting comparison. They're not all equal as far as the weight in the index goes. So we ended up having a rough Thursday and Friday until that late rally. But like I say, underlying breadth was positive, and that's something to note, which means that investors were actually picking up buying stocks. They just weren't buying the big ones that would make the market go up higher. So that was something that we wanted to keep an eye on.
Okay, and how is the technical condition of the market doing?
Now, we did see a little bit of deterioration in the technical condition of the market last week. We did drift a little bit lower, snapping those win streaks. The Dow Jones was the weakest index. It did fall below support at its 50 and 100-day moving average. Traders will watch that closely. We did, I think on Friday, it managed to stay up. Actually, it rallied up right up to the 100-day moving average and ran into resistance. So that was a place where you might expect that if it was going to stall, where you might expect it to do it, and it actually did. Now, the good news is that it was able to stay above the April low of 37,611. Now, that was a positive. That keeps us in the track where we're making a higher low, and well, right now we're making lower highs, but it's possible that we can make a run towards some of those highs a little bit later. So what we want to watch here over the next couple of weeks, although I do think we'll probably see some positive action for another couple of weeks while the CTI is bullish. I want you to keep an eye on that 37,611 if we would sell off and break that. And right now, today, we're off another 250. We were down 300 something. We're still at 38.4. So we are up, about 800 points still above, that low that we need to keep our eye on. If by chance we would break that, then you might actually see that would open the door for a retest of the 200-day moving average on the Dow. I think you'd probably get down to around 37.50. 200-day moving average, I believe, is around 36,780. So those are some numbers on the downside that you may want to watch.
I also remember that we had an interesting MACD technical event. Can you elaborate a little bit more on that?
The S&P 500 had a bearish cross on its MACD. Momentum was pretty much neutral. S&P 500, we look at things called FLDs, which are future lines of demarcation. We help get our targets off and see whether the indexes are going to break lower. If the S&P 500 has support around that 5,200, 5,210 range, it held that on Friday when it sold off and then came back up. But if we would get in something happening here where rates would start to tick up again or something else goes wrong, we could see that index retest the May lows around 5,000, 5,025. I don't think that's where we're headed right now. I do think we're going to probably move higher. The NASDAQ, if we do see a shift out of some of these overweight big cap technology shares, we could see that index overreact to the downside, and that index would probably find support around 16,350, 16,380. Right now we're around 16,740. So it's got a couple hundred points before we would need to start getting a little bit nervous on that. But as I mentioned, Friday's action was good. We are seeing better breadth going forward here as the market's kind of been going back sideways. And we did see actually the Dow Jones Transportation Index and the small cap Russell Index, which it's kind of nice to see if they can lead the market higher or lower. The Dow Jones Transport went down to 14.8, which was its April low, and that was also a support and resistance level back in November. It did hold that, bounced off of that level, and actually ended up 1% for the week. That's something we want to keep an eye on. It is down 1% though for the today, which is a little bit troubling. We would like to see some carry through on that, but we're right now at 15,000, so we have another 200 points to the downside that we want to keep an eye on that index, that 14.8 level. The Russell 2000 was able to find buyers at its 50-day moving average. That's a technical level that traders will be watching, and it actually, I think, it ended up flat, but that still was better than the broader market. So again, I think we kind of came down, tested some support levels that were, traders were keeping an eye on that. We did kind of bounce off of them and worked our way higher. We'll have to see what happens, during this week. There's a lot of May data coming out, We did get some today that wasn't all that great. We got the ISM manufacturing index, which was lower than what we thought it was going to be. They were looking for 49.6. It came in at 48.7. So, the manufacturing data is coming in weaker than what we're looking for. We also saw factory orders fall for a second straight month. Now, that did help. That actually brought rates today down quite a bit. I think we got down, we were pressing up around 480 about a week and a half ago on the 10-year Treasury. We're down to 440. Like we mentioned, the 2-year Treasury was coming up around, had gone over 5%. We're back down around 4.7 something on that. So that will, as rates start to pull back, that can, that keeps a floor under stocks in here. Now with that fall in the manufacturing data today, we actually saw, as rates fell, the CME FedWatch group, we're right around at a coin toss, right around 50% on Friday as to whether or not they would project maybe a rate cut in September. With this data today, that jumped up to 59%. So again, as the economy slows, you have to keep an eye on that to make sure we're not in for a hard landing before they cut rates. They're still looking for a soft landing, and hopefully they can start to cut rates before the economic activity slows too much. And we're at the point right now where it's going to be a nip and tuck whether we can keep cutting rates enough that we can keep the economy flat to at least growing a little bit.
And how is the underlying market breadth doing?
The underlying breadth, we talked a little bit about last week, it wasn't much of anything. Actually, it was basically mixed. I think the NYSE had, despite that couple down, 1%, it had positive AD line. The NASDAQ had a negative AD line by 800 units or something like that. So nothing big on that.
And how are we looking for investor sentiment?
Investor sentiment, we did see a small decrease in the bullish investors, mainly on the retail side, but the investors overall still remain overly bullish, and they're above historical norms, which when they get almost right around the point where we're at right now, that could be a contrarian indicator, as it means if everybody's on one side of the trade, if everybody thinks the market's going higher, well, everybody's already invested and there's no money to put into the market. And that's why if somebody starts to sell, it can go down faster than what we look at. So, with that, wrap things up. We kind of have first quarter earnings in the books, but we do have some headwinds over the summer. We could still see inflation being stickier than what the Fed's looking for. That would be a negative for the market, because that would mean, despite the economy slowing, that means that they'd have to keep rates a little bit higher than what they want to. And then you'll start getting more talk about a recession and a hard landing for the economy. The other thing I wanted to bring up is that the cyclical trend index, which is a MarketEdge proprietary market timing indicator, has been around for 30, 35, 40 years almost. We are bullish at this stage. I think we're probably going to, it should stay bullish, for a couple more weeks and into July anyway. And remember that is a forecasting tool or forecasting model. So it's not like with the second opinion, when you look at that, that's a trend following model. And it's telling you, okay, everything looks good, the thing should keep on going up. The CTI is looking ahead for different cycles that go through the market. And again, we have some cycles that are going to probably start to roll over into a negative count towards the end of the summer. June is usually a fairly good month for the NASDAQ. Into July. August overall for the market has been pretty rough the last couple of years. So it's kind of working out again where we could see the market struggle going into the fall. And of course, we have the elections coming up. I think a lot of investors will be more than happy to kind of step back and see what kind of BS we're going to have with the election going on. So I mentioned that I think that over the next few weeks, if we get a couple of days where you see, where you get a rip in stocks where maybe you're all of a sudden up 300 or 400 points, you might want to consider lightening up. And then if we get some dips, I don't think you want to be buying every dip over the next few weeks. I think you may want to wait to see if it's going to bounce. And then if we start to pick up, we can just kind of watch this. So I would be cautious. I don't see just a summer rally going on in here, but I do think we can work our way sideways to maybe a little bit higher over the short term.
Okay, great. Well, speaking of that, I know you mentioned the downside targets. What are you looking at for the current upside targets for the major indexes, and how do you
Okay, one of the things
calculate?
yeah, one of the things that I mentioned these FLDs, which is Hearst had developed these things years and years ago. On the Dow Jones, I think if we can get some action, get some buying going on, the upside target at this stage would probably, I think if we get to about 39.5, I think you're probably not going to get able to crack much above that. On the S&P 500, I think we can probably get another run up to around 5,300, 52.95, 53.05, 53.10, something like that. And the FLDs would cap that at right around those numbers. As far as the NASDAQ goes, it doesn't have a lot of upside either. I'm looking probably at 16,850, 16.9, going up towards that 1700. I don't think we're going to get to the old highs that we saw here, about a week or so ago. So I think when you get up near those levels, do what you may want to do some defensive action, whether you're selling covered calls or maybe you buy put on the indexes or something like that, just to kind of hedge yourself a little bit as we get rolling into the summer.
Okay, great. And then you also mentioned the MarketEdge CTI projection being positive through the end of June. And considering that the S&P oscillator came off all the way from a recent high of 8.22 2 weeks ago, would you say that the recent sell-off was technically healthy for the overall market?
I think it's healthy if we hold. If we if it just keeps on going down, that's not too healthy. But I do think that we did get overbought, and part of that was the S&P oscillator will get overbought because we were seeing a broadening out of the market there for a little while, and that's good. That's you'll see that thing flat, like kind of where it was on Friday, when you start to see the Nasdaq's going up, the Dow's going down, and things are mixed. But I think that we fell back now off of those highs. The Dow was off almost 5% from when it hit 40,000. So and then it came back down and held support levels. That's a pot. Well, the Dow, not really. I mean, it did go below the 50 and 100. So I think you're going to get back up close to those things. If we can pop above those, which are now resistance levels, that would be good. But yeah, when you get some backing and filling in these markets, that's a positive, as long as you hold previous lows, which we did.
Okay. And so the last question that I have for you, and it's something that continues to stand out to me, is how resilient the investor sentiment has been and has been really hanging on to historically high levels. Can you explain why that's something that we want to keep an eye on and what that can do for the overall market?
Yeah, like I mentioned, for one thing, one of the things is keeping historically, when the Federal Reserve, when they announce that they've topped out on rates, and then you're expecting to see rate cuts. That period when you're not doing anything, when they're not doing anything, is when the market actually performs the best. Okay, so they announced, I believe, last October that okay, this is about as high as we're going to go, and we'll start looking at rate cuts. Of course, the crazy bulls started saying, we're going to have 6 rate cuts 2024. Now we're looking at maybe 1. So they got a little over rambunctious on that. But the market performs best when the Federal Reserve is on hold, and which is what we've been since October. And we've seen a great, a nice rally off of that time period from when they said, okay, we're done. Now the fact is, once you start lowering rates, that's also bullish for the market, in the fact that it kind of puts a put underneath the market, because you get to the point where if rates keep going down, your return on fixed income and bonds and stuff like that is going to be so low that people will want to speculate a little bit more, and they start to they want to be in stocks, because they don't want to make 2% on a CD, whether they can make 2.5% or 3% on a dividend in a stock, and they'll take a little bit more risk. So that's why people are remaining bullish. I did say that when you get overly bullish, it does become a contrarian indicator, meaning that everybody's on the wrong side. In other words, if if we have 10 people and we all love the market right here, we're already fully invested. So who's gonna put more money into the market to drive it higher? I think that's kind of where we're at right now. People have been buying the dips since October, November, and that's why we're having a hard time pushing it higher in here. And you're starting to, the market going sideways when you look at the different major averages over the last month or so. You're not getting a lot of headway. You have some big up days, you have some big down days, that type of thing. And and then once everybody is overly bullish, if all of a sudden something happens, and if everybody's long and something happens that they need to take some money off the table, well, if everybody's long and once everybody starts to sell something, that again just induces more selling, and then you'll correct to even more so on the downside. So that's why it becomes a contrarian indicator, and why when you get this overly bullish or overly bearish index, readings, you want to be a little bit more cautious.
Okay, great. Well, that is very helpful information, David. We are actually close to running out of time for this week, but is there anything else that you would like to add going forward into this week?
Yeah, just real quickly, you're going to get some manufacturing data. We'll keep an eye on that. The big thing to watch for is the government's jobs report on Friday. Remember, as we're going along, the Federal Reserve has mentioned several times they would like to see, a softer jobs market, which would give them a little bit more room to begin to talk about cutting rates. As long as the jobs stay like this, that means that keeps upward pressure on wage growth, that type of thing, which is bad for inflation. So we need it. It'd be nice to see, maybe where we get a tick up to maybe, the payrolls get under 100,000 or under 200,000, something like that, which would show a little softer jobs market. And I think that could help the Fed again start to talk about, well, maybe September would be a time when we could begin to cut rates, and that would keep a floor under the market in here.
All right. Well, David, thank you for all of the very helpful information. We do have to wrap up this week's Tech Talk Tuesday. We want to take a moment to thank all of our listeners, and we will go ahead and catch you guys next week.
That sounds good.